Well, good morning. It's me, yes, Kenny Polcari, coming to you live once again from Grand Central Station in New York City. It is Thursday, January 15th, 2026, and here are the things that you need to know to get your day started. Well, earnings are doing the job. Investors and traders get to react, and that's just what they're doing. The tape continues to show rotation, not a recession. The economic data remains strong. PPI, though, surprises to the upside. A little bit of concern there. Politics are always noisy, and it creates volatility. And it's that volatility that creates opportunity. Oil is down, gold is steady, bonds are up, yields are down. And what do we have for dinner tonight? We're going to have the 𝐻𝐞𝐿 with sausage and peas. So delicious and so simple to make. Okay, look, it was another day, another data dump, another round of earnings, and the scoreboard keeps lighting up, right? Tuesday, we went 3 for 3 in the earnings. Yesterday, we went 4 for 4 in the earnings. That makes it a perfect 7 for 7 to start the earnings season. Now, yes, there are some issues under the sheets, but nothing to suggest any weak performance. Every one of them beat expectations on the bottom line, while some left questions unanswered and others were cautious in the forward guidance, which, by the way, is okay. Cautious is good. You try not to make promises you can't keep, but then you leave the door open to outperform as the year progresses. Remember, expectations for this earnings season are high. So when they don't meet or they leave us wanting more, then the path of least resistance is down, not up, especially when the market is already priced to perfection. This causes trader types to react one way, while the long-term investor reacts differently, right? Because they both have different views. One's a very short-term view, one's a much longer-term view. Now, look, it's okay, it's early days, but so far, earnings are doing exactly what they're expected. Yet, stocks are putting in a mixed performance, plunging once again on the opening bell yesterday, only to work out the kinks as the day wore on. At 4 p.m., this is what the scoreboard looked like. The Dow, well, lost 42 points, but it was down 340 points at 11:30. The S&P lost 36 points, 0.5%. The Nasdaq got whacked over the head again, losing 240 points or 1%. The Russell bucked the trend and rose 18 points or 0.7. That's an interesting thing about the small caps. We've been talking about that. The transports rose 3 points. The equal-weighted S&P rose 32 points or 0.4%, while the Mag 7 gave up 536 points or nearly 1.6%. Again, note the divergence between the S&P and the equal-weight S&P. Now, the economic data crushed it. Mortgage jobs surged 28.5% versus the plus 0.3 last week. Retail sales came in at up 0.6. Ex-autos and gas up 0.4, both better than expected. Existing home sales, they blew right through the 2.2% estimate, coming in at a strong up 5.1%. Now, before you go celebrating, though, there was a caution flag and a reason for tech investors to become cautious. The November PPI report came in stronger than expected, and that's not what you want to see. Just like CPI, you want PPI to come in weaker, because weaker suggests inflation is easing, cooling, or fading, right? A stronger than expected PPI print suggests inflationary pressures are building, they're firming, they're reaccelerating, they remain sticky, and that is not what the doctor ordered. And then soon after that report, we heard from the Atlanta Fed president, Rafi Boston. We haven't heard from him in a while, and he wasn't really being dovish at all. In fact, he struck a decidedly cautious tone, making it clear that the Fed is in no rush to continue to cut rates. He said that inflation, the fight is not over, that price pressures remain high relative to the Fed's 2% target, and there's a still resilient economy could actually keep upward pressure on inflation. Now, did someone say a 2027 rate hike? He didn't, but Jamie Dimon did. Now, his message was simple, and it was consistent with what we've been hearing. Policy needs to remain restrictive for now. And I'm not even saying 3.5% is restrictive. I think it's neutral, but whatever. Cuts are not imminent. The Fed wants to see a clear, sustained progress on inflation before even thinking about further easing. Translation? The holding pattern remains very much in play, which means that the whole policy pivot thing that the algo crowd, the fast money traders have been hoping for, guess what? Not happening at the moment. So can we put that to bed now, because it's exhausting? In fact, Fed fund futures are now pricing in just a 5% chance of a cut in January, a 23% chance in March, an 18% chance in April, and a 50% chance in June. Now, for now, June represents the high water mark. Beyond that, the probabilities of a cut actually decline as the year goes on. So be careful how you think about this, right? So the rotation out of the richly priced tech into the more appropriately valued, economically sensitive names have continued to send the NASDAQ and the Mag 7 and the semis and cyber, etc., into a tailspin, marking the worst decline in about a month. But it's not all that bad. 300 of the S&P 500 names ended the day higher yesterday. The SMIDs, the small and the mid-cap, ended higher and has now beaten the S&P for 9 straight days. The value trade, the SPYV, was up 0.3, while the growth trade, the SPYG, was down 1.2. In fact, the value trade is up 2.5% year to date. Now, while the growth trade's only up 0.1%, and again, it's early, I get it, but it's just worth noting and paying attention to. 7 of the 11 major sectors ended higher. Energy up 2.2%, consumer staples up 1.4%. That puts them up 5.9% year to date, just FYI. Real estate's up 1.1%, healthcare up 0.7, utilities up 0.7, industrials up 0.2, while basic materials inched 0.1% higher. Tech lost 1.2%, consumer discretionary down 1.6%, communications down 0.2, and financials continued on the downside, down about 0.1%. And so the K-shaped economy continues. Now, for those of you who are unclear about what the K-shaped economy is, let's make it easy. One part of the economy is doing just fine. Asset owners, large corporations, and well-capitalized investors. That's the top half of the K, right? It points up. The other part is struggling. Households squeezed by higher prices. Smaller businesses fighting higher costs. That's the bottom half of the K. It goes down, right? So this divergence is one of the defining features of this cycle, right? This K-shaped recovery aren't always the historical standard, but in a world of massive shocks, so think financial crisis, pandemic, global shutdown, massive aggressive policy intervention, and uneven access to capital, they're becoming more frequent and more persistent. That divergence is a defining feature of this K cycle, right? Both realities can and do exist at the same time. And so the hope is that the bottom part of the K eventually catches up and turns around. Now, that would mean wage growth broadens out, which it is. It means inflation continues to cool, which it is. And opportunity spreads beyond asset owners, so the recovery becomes more inclusive and more durable. Economic data today includes the usual suspects. Initial jobless claims of 215,000 and continuing claims of 1.89 million, both in line with where they've been. What we want to see, though, are claims go lower. We're going to get that read at 8:30 this morning. Earnings are expected from Goldman, BlackRock, and Morgan Stanley. Goldman and BlackRock are trading a bit lower in the pre-market. Morgan Stanley is trading a bit higher in the pre-market, up about 0.9%. Bonds rose yesterday after data suggested, guess what? No cut is coming, right? Refer to my comments above. The TLT gained 0.6, the TLH gained 0.5%. That said, yields a bit lower. The 10-year is now yielding 4.13, the 30 is yielding 4.78. Oil, which had spiked higher over the last week due to the massive protests in Iran and the unrest it created for Iranians and the global oil markets, is lower this morning, down $2.73, or just over 4%. Right, it's trading at 58.28, back below 60. Now the pullback comes after President Trump warned that if Iran followed through on hanging that young 26-year-old man, Irfan Soltani, who was protesting against the regime, or continued killing their own citizens as they have been doing, there would be hell to pay. The Ayatollah initially pulled back, poking Trump in the eye, briefly turning up the geopolitical temperature in the room, right? And that was enough to send oil spiking higher on fear of potential military escalation. But that defiance was short-lived. The Iranians saw the light, and cooler heads have prevailed, causing tensions to ease, at least for now. The rumor is that the current regime is changing their address to somewhere in Moscow. As a result, oil is retreating back to the defined range of $55-60 as the markets refocus on the basic supply and demand equation. Gold remains closer to its high. This morning it's down $12 at $46.10, just $30 off of yesterday's high of $46.40. There's no change in the narrative. Momentum buying, safe haven buying, and central bank buying. It's all the same. European markets are mixed. TSMC, Taiwan Semi, reports a 35% increase in fourth quarter profit, breaking all the estimates as demand for AI is, guess what? It's not waning. TSMC is up 5% in trading. ASML is up 9%. BE Semiconductor is up 5.6%, all on the back of the positive Taiwan semi-news. U.S. futures are all high this morning. The Dow is up 40, the S&P is 25, the Nasdaq's up 180, and the Russell's up 5. Goldman and BlackRock, like I said, are trading a bit lower as we wait for their earnings. Now, we're still waiting on the Supreme Court. Nothing yet on tariffs, so for now it's a game of hide and seek, right? Trump says he's not firing 𝐿𝐭𝐲, so can we stop the histrionics, please? And at the same time, global investors are watching a high-stakes meeting today between U.S., Denmark, and Greenland. Recall, we know this, that Donnie views the territory, Greenland, as strategically critical to U.S. national security. The Danes may not see it quite the same way, but geopolitics, being what they are, have a way of surprising people, so only time will tell, and we'll wait to see what that response is. The big picture, this isn't something that reprices stocks over the long term at all, but in the short term, it can matter. Why? Because it raises the political temperature in the room, and whenever politics heats up, volatility usually follows, and it's the volatility that creates the opportunity for the long-term investor, and even for the day trader short-term investor. The S&P closed yesterday at 69.26, down 36 points. This morning's action suggests a bit of bargain hunting, especially in the tech space on the back of the Taiwan semi-news, as well as the pullback in the sector over the past couple of weeks that we've seen. For now, the indexes remain comfortably within a well-defined range, right? With trendline support down at 68.20 and resistance up around 7,000, more psychological than technical. Now, if earnings continue to beat expectations and economic data remains supportive, then the likely path in stocks is going to be, like I've said, it'll advance, it'll backfill, it'll advance, it'll backfill, but the trend will be higher. In the end, the message is unchanged. Stay disciplined, stay focused, always stick to your plan, and don't get drawn into the fray. You can call me at 561-931-0190. Let me give you a free no-obligation portfolio review. Let me help you assess the risk in the portfolio versus the risk that you think you're comfortable with. Okay, so what do we have at dinner tonight? This is such a great dish, and it's easy to prepare, and it will become one of your family favorites. It's 𝐿𝐭𝐻𝐻 pasta with sweet sausage and peas. And 𝐿𝐭𝐻𝐻 pasta is little ears, right? That's how it translates. Now, for this you need a pound of the pasta, you need olive oil, you need sweet sausage, you need a big Vidalia onion, you need garlic, you need frozen peas, salt and pepper, white wine, or chicken broth, one or the other. You don't have to use both, and plenty of fresh grated Parmesan cheese. You want to begin by bringing a pot of salt and water to a rolling boil, put it on the back burner. In a large saute pan, add a splash of the olive oil. Now add the sweet sausage meat. You've taken it out of the casing, break it all up and brown it, right? When it's done, just remove it, put it in a bowl, and just put it on the side. Go back to that same pan, add a little bit more olive oil, add the sliced garlic, like about 3 cloves worth, and the chopped onion. Saute until it's soft, like 5 or 8 minutes. Then you're going to add back the sausage. You're going to hit it with a splash of wine, about a cup of white wine or a cup of chicken stock, whichever one you're using. If it's the wine, you want to bring it to the boil, let the alcohol burn off. The chicken stock, just bring it to a boil. Now, you're going to add in the bag of frozen peas. You're going to season it with salt and pepper. You're going to turn the heat down to medium-low. You're going to cover it. You're going to let it cook for about 10 minutes. In the meantime, you're going to add the pasta to the pot of salt and water. You're going to cook it until it's al dente, about 8 minutes or so. Then you're going to add the pasta directly to the saute pan using a slotted spoon. Just scoop it out, put it right in the saute pan with the sausage and the peas. Mix it really well. Then be sure to add 1 or 2 handfuls of fresh grated Parmesan cheese and mix it. Serve it immediately in warm bowls. You're never going to go wrong. If you really want, you can add some warm toasted garlic bread with this dish, because it's always delicious. Listen, at 10 o'clock, I'm on with Stuart Varney on Fox Business from 10 to 11, and then I'm on my way back to Florida. So until tomorrow, take good care.